check out solid gold, losing a bit of shine over the past week or so as the markets rally on hopes of a trade deal. I'm glad you guys can't see what's going on here on the desk because everybody's dancing. That, by the way, has not stopped Citi from coming out with a huge bullish call on the yellow metal, saying $2,000 an ounce is possible, quote, in the next year or two as low rates, escalating recession risks, and geopolitical tensions make the yellow metal an attractive alternative to equities. So are you picking up Citi's call on gold? You guys are just...
I am lost in the disco beat right here.
That's Beyonce, I think, singing that.
Beyonce.
That's a redo of something else, by the way. That's the way I like it. Okay. Anyway, that's the song, Gold to 2000. I think if you believe that the turnaround in yields over the last 2 or 3 days and almost a 30 basis point move in the 10-year is a function of the deflation trade running out of steam, or we were overdone, then I think gold to 2000 is going to take you some time. But all the structural elements of what took gold to 5-year highs after running into 1350 resistance, I think, are still very much in place. But I think we've had an overbought condition in gold, and I think we're still working that off. I would not buy it at 2000.
I think what's interesting about Citi's call, and also some other calls that we've heard from the street that are getting more bullish on gold, is that they're underlining this sort of, I don't want to say secular shift, but a real change in the way central banks are buying gold and why they are buying. They want to move away from the U.S. dollar. They want to de-dollarize their reserves. And so, therefore, they're looking for other assets, which would be
gold. And we've talked about that. I mean, the central bank buying, we've talked about for months on the show. Pete's been talking about gold and silver for a while as well. It's central banks are buying gold. The Chinese are buying gold. The Russians are buying gold. You can look it up. You can see for yourself. So I understand. Tim said it's working off an overbought condition. I agree 100%. I'm more in the Citi camp. You know, maybe there's a little more maybe there's a little more sell-off here in the gold market based on the fact that bonds probably got overbought. But I do agree with Citi. I think gold's going higher as well.
All right. Our next guest says you may want to look for cover while the market faces some pain ahead. Let's bring in Joe Zidle, Chief Investment Strategist at Blackstone. JZ, good to have you back.
Thanks for having me back. Good to see you.
Has nothing changed? I mean, we've seen this sort of shift, rotation, right, out of the momentum trade into some of these that doesn't give you any hope that the market is settling in, and yields have gone higher too, which has helped.
I think it's all a reflection of this, renewed optimism on trade talks, right? So last week, the U.S. announced that it would be engaging China in October, and you saw the curve re-steepen. You saw equities catch this bid. Credit spreads remain pretty orderly, and I think it's this newfound hope that something's going to get done. But I'm a little bit more pessimistic. I don't think that we're going to see any quick resolution to trade whatsoever. So I think this move back to a pitching wedge away from all-time highs in the market is really just much more of a head fake. I think there's downside risk. And if you look at what China's been doing recently in order to prepare for this trade war, basically they've retaliated against the United States by taking up their tariffs, but they're lowering tariffs to the rest of the world. In other words, they're prepared for a prolonged fight here. So I think any hope of quick resolution here is misplaced.
So I'm a little skeptical on the gold as a deflation hedge when I've heard it as an inflation hedge for the 25 years prior, right? Yeah, okay, it's an everything hedge. Why? Explain the deflation hedge part.
Sure. I mean, I think it's been a very interesting move watching gold as this sort of like antidote to all these negative yielding bonds all around the world. And if you think about it, are you better off holding gold or 10-year or 30-year German bonds at negative yields? Neither one's necessarily going to pay you, but at least gold has a chance of maybe going up. So I think that's sort of the conventional wisdom that's driving gold. And my guess is that if the ECB does have to bring more rate cuts and some sort of significant QE package, then maybe rates in Europe will dip back lower. And I think that would provide a little bit more of a lift to gold prices. If trade breaks down, which I expect to happen, perhaps you see another move up for gold. So I think people are looking at it as this sort of like antidote to all these negative yielding bonds out there. So it does seem to make sense.
Joe, inherent in your pessimistic view is a credit view. There has to be, right? What's the timeline for you on when we really start to see credit spreads widen out? Because, as you said, so far so good.
Yeah, I mean, I think it's a really good question. And for me, it comes back to yield curves, right? Yield curves are the best predictors of business and economic cycles. And it's not just the yield curve in the United States that inverted, right? The 10s inverted a couple weeks ago. They've now re-steepened on the hopes of trade. But in the month of August, you basically saw 7 or 8 different parts of the world with inverted yield curves. And that was the most since 2006, 2007. So all around the world, it's telling you that there are economic problems that are brewing. And I think, from my perspective, at least, we could start the countdown timer on the end of this expansion, which means at some point it is going to translate into some sort of credit event. When it happens, it's a good question. From the time the 10s, 2s inverts, you generally have about 20 months before a recession. That's the average. And that means there's never been a recession 20 months later. It's either shorter or longer. Right? It's the beautiful law of averages. So if you have to take an over-under on when this expansion is going to end, I would say I would take the under at this point. I think trade tensions globally are causing a manufacturing recession, and I think that spills over to the broader economy. You've got Germany, who's for all intents and purposes in recession. Italy's been there. The UK is there. Japan is headed toward there. Singapore is very trade exposed. Right? They had a massively negative GDP print. All these things, I think, will translate into a credit event at some point. My guess is it probably happens sooner than the market thinks.
So how do you think we finish out the year? And I know it's sort of an ambiguous question, but it almost feels like we're setting up similarly to how we set up for the end of last year, in that the backdrop looks a little worse. I mean, the main thing that's changed is that we have a supportive Fed. We have a Fed that's already said, you know what, we're going to do whatever we need to do. And that is, of course, a big help. But at the same time, right now, we've got tariffs in place and tariffs going higher. We've got an economic backdrop that hasn't necessarily improved compared to last year. And we're entering an earnings season where companies are going to be talking about the impact of all those tariffs.
Yeah, I mean, I think you're right. Earlier you were talking about Apple, and if you think about Apple for a second, the iPhone, at least this iPhone right here, I don't know about the new ones, but this iPhone travels about 500,000 miles before it ends up on a store shelf, right? When you think about the Apple supply chain, this iPhone goes through 45 different countries and 1,000 suppliers. It would literally get upgraded on United before I would. It's got more miles. So as you think about the unintended consequences of trade, you've got to wonder, is it going to be a corporate profit story because of higher input costs, or is it going to be like a consumer CPI story because companies pass those along? Neither one of them are good. So in terms of how we set up for the end of the year, I think that the highs that we hit, back in April that we're now testing, I think are going to be the highs for the year. I think markets are going to be more volatile and probably trade down. At the beginning of the year, we came out with a price target of about 2,900 or so on the S&P 500. So we thought the market would be up plus 15% for the year. We've hit it. We're sticking with that target. I see more volatility, and I think risks are to the downside.
All right, Joe, thanks so much. Good to see you. Joe Zidle, a.k.a. Jay-Z. We do have breaking news here on Peloton. Let's get to Deirdre Bosa. She's got the details. Deirdre.
Hey, Melissa, Peloton just moments ago filing an amended S1 ahead of its expected IPO. It will be offering 40 million shares at a range of $26 to $29 per share. That should raise it between $1.04 to $1.16 billion. We're still crunching the numbers and tell you what kind of valuation that gives the company, but it was last valued at $4.15 billion in the private market, and it is expected to kick off its roadshow tomorrow. Back to you.
All right, Deirdre, thank you. Deirdre Bosa in San Francisco. So Peloton to start the roadshow tomorrow in this kind of environment, Guy.
No, and I'd say the people on both sides of the spectrum there, a lot of people say completely overvalued. They're selling $2,000 bikes, $5,000 treadmills. There are other people that say it's a transformative device, both the bike and the treadmill, and that the service side of things, $50 a month is a small price to pay. I'd probably come down on that, but I can understand if you think this is totally overvalued and probably top-ticking the market in terms of another WeWork type of IPO.